I'm Ryan Lightfoot-Brown of Chelsea Financial Services. We're joined today by Steve Andrew, manager of the M&G Episode Income Fund. Thank you very much for joining us, Steve.
Hi Ryan, no problem.
Now your fund is a little unusual in the fact you use behavioural finance in your process. Can you just talk to us a little bit about that?
You're right, it is unusual. Behavioural finance, it calls upon behavioural psychology and says, how can we best understand market volatility? Because the market's populated by human beings, just like us, making decisions, and understanding volatility, we think, is the key to identifying what constitutes an investment opportunity and what constitutes something that you'd rather stay away from. So we try and look at that in two ways. Firstly, let's understand why the market's taking the decision that it's taking, be it overly fearful of some event, be it exaggerating a trend in economic data or whatever it might be. And then secondly, to remind ourselves of the humanness of our own decision making, our own frailties, our own weaknesses as egos operating in the market. So we have a solid team of individuals that can say, well, hang on a second, you're not really being consistent with that. It reminds me of a quote from Mike Tyson, which is, and Mike Tyson obviously had many sensible quotes, and one of which was that everyone has a plan until they get punched in the mouth. When you get punched in the mouth, you need to pull yourself up and say, well, what is the plan? What are we trying to do here? How can we deploy our process amid what looks like a really confusing environment?
Okay, and have you got a couple of examples of the market behaving irrationally in the last 12 months or so?
Yeah, a couple of really good ones, I think, and a few of them ongoing. And the ongoing ones, of course, we look at them and think, wow, that's just not working, because that's the nature of an ongoing opportunity. Firstly, if we think about, let's think about Italy and Italian government bonds. So we had a few episodes over the course of the past 12 months where the market's really saying, we believe Italy's a credit rather than a sovereign issuer. So it's a risky rather than a safe issuer. So its price behaviour becomes no longer correlated with core European risk-free assets. It becomes correlated with risk. It becomes correlated with European bank equity because of a fight taking place, a drama taking place between the European Commission and the Italian government over their budget. Now, Italy remains part of the euro area, then it's a sovereign, and it should be treated as such with a narrow spread over German government bonds. If it's a credit, then it should be judged solely on its budget deficit. Now, if it exits the euro, it's a credit. So it comes down to a probability question that says, how likely is Italy going to stay in the euro, yes or no? And if you've got the election of a populist government, and popular opinion in Italy is actually facing in the other direction, saying, well, we don't want to exit the euro, thanks very much. So it's a matter of observing the price behaviour seemingly being driven by a narrative that says Italy's more likely to leave the euro, and yet pulling back and saying, well, what are the facts around that? What can we say about those facts, and should we stand against that? So taking those opportunities throughout 2018, well, one of the few, thankfully, you need to look for opportunities amid the volatility because sometimes you just don't know how many opportunities you'll get. And they were one of the few positive contributors to return that we felt were kind of valid statements of value throughout last year and actually were good positive contributors to the portfolio. Another one, incidentally, because we were talking about two, another one that's ongoing would be Japanese equity. So Japanese equity correlating very closely with European equity and selling off in bouts where the market would seem to be worried about growth, seem to be worried about the fragility of the euro but as a project, and yet seemingly not paying that much attention to positive earnings data from Japan, to the boring stuff. It's the punched in the mouth, what's the plan question, which says, okay, well, the market's beating us up here, it's down 10% or whatever. What changed in fact, and what might be more driven by emotion? And when we look at today, and we look at the trade war, you could say there's a great deal of emotion manifest in current market behaviour, because even what are we worried about with the trade war? Well, we're worried about loads of tariffs on exports and imports and trade barriers going up. Now, even the most pessimistic of forecasts for an escalation in the trade war, for a blanket coverage of exports and imports from the US and China, even the most pessimistic, the numbers, which is what we should all be interested in, of those who are most pessimistic, are no bigger than the average forecasting error for US GDP. So that tells us the degree of confidence that we might want to have and express when we think about the fear and the downside. So if markets are offering us a heavily discounted asset, like equity, because of a fear of some unknown future, then we should think seriously about taking that on. So that's how behavioural finance and behavioural psychology interacts with how we act amid volatility.
Okay, and in that you mentioned Italian government bonds.
Yeah.
I've noticed that 8 of the largest 10 holdings in your portfolio are other government bonds. You've got US, Mexico, Brazil, Argentina.
Yeah.
Can you just tell us about why they dominate the mix? It's quite an intriguing combination. And then you've also got a mix of 5-year bonds and 30-year bonds. So why you've gone sort of those two different...
Absolutely, and all performing different roles. And this is, for me, this is the beauty of running a multi-asset portfolio where I can directly invest. So what I'm trying to deliver with this portfolio is a sustainable income over a multi-year, multi-decade period. So we do that by making asset allocation decisions at the portfolio level that make money, but then we build a portfolio of assets that deliver to us a steady stream of income. So we grow the pot and grow the income at the same time. The way the government bonds contribute to that is twofold. Firstly, you've got your US Treasuries currently as the only risk-off safety asset in the portfolio. That's the diversifying asset for all those lovely equities that are exposed to future earnings growth in the portfolio, but they're more volatile. So what we want to do is balance that at a good price with US equities. So if you've got the risk-free issuer of dollar debt offering us a yield of 3 and a bit % nominal, then we think this is quite good value. And crucially, we don't really need to be taking any views on what the future looks like, because if we've got economic growth continuing, the earnings will contribute to the equity asset improving in value. If we don't have economic growth and there's a recession, well, we acquired the US Treasuries at a good price and the market would discount future interest rate cuts, and we're already seeing a bit of that at the minute where the long end of the curve has started to rally. So there's a very strong portfolio aspect to the US Treasuries, and we've currently got nearly 20% of the fund in the long end of the US Treasuries. Looking further afield at what I guess you could call the non-mainstream government bonds, the Mexicos, the South Africas, those sorts of things, they're contributing at a different level. So they're the shorter maturity but higher yielding. So we're acquiring them again at a good price, getting some good portfolio currency diversification, and crucially, a bit of income contribution from those guys as well. So less of a dominant portfolio role as an asset allocation device, more of a bedrock income and value diversifier.
Okay, and within that, you mentioned sort of the US and Japan.
Yeah.
But of your equity holdings, your largest allocations are those two and Europe as well.
Yes.
Can you just talk about why you've got Europe and also not so much UK? Given it's so out of favour at the moment, we thought it'd be quite an interesting sort of contrarian play on that behavioural finance.
Yes, I think that's a really good point, because the UK, you could absolutely make a case in isolation for saying, yeah, the UK is a good price, UK equity assets are a good price, because the market is discounting the fact that Brexit is bad, and Brexit might be good or bad, nobody knows. That's the beauty, albeit a distorted, ugly beauty of Brexit, is that you don't actually know whether this is good or bad. What we know as investors is enough to say, well, if we don't know, neither does the market know. And if the market acts like it does know, then we should be interested, because the probability spectrum has shifted. The market's only leaving room for surprise or disappointment on one side of that. So yes, UK assets have been heavily discounted, but it just so happens that the competition is fierce for heavily discounted assets, particularly on the equities side.
And what about the opportunity in Europe?
Well, European equity opportunities have been very interesting over the course of the past 12 months. 2018 was a very challenging year in terms of price behaviour as the market reacted to things like the US interest rate picture, things like the budget wrangle between the European Commission and the new Italian government, all of which really amounted to a good deal of noise, or at least the majority of which was noise. We had to kind of disentangle through some of that to say, is there anything in the balance sheets here of the banks that gives us a degree of comfort that they've already turned the corner, that we can build a decent portfolio here of 10 or 12 banks with good cross-border activities and strong balance sheets. So we look for growing earnings and we look for solid valuations. And then when the market gives us those opportunities and we think that, well, the market just seems to be overreacting to stuff here and nothing tangible that has fed through to earnings, then we'll build the portfolio. So 2018 could really be seen as can be seen in two diametrically opposing ways. Firstly, you could say 2018 was really horrible, really disappointing, a terrible journey and all of that stuff. Or you could see it as that was actually quite a good period of opportunity for those that had the plan, for those that got punched in the mouth and said, well, what's our plan? Is it something that we can apply to this, where the facts are actually improving and the price isn't, so we need to take action on that. So that's where you hope you're laying down future returns for the portfolio. So that does provide a good solid exposure to the whole risk area of the portfolio. Then when we, as we were saying earlier about US Treasuries, if we don't get the growth appearing, what we want is some good solid diversification on the other side of that. So that's the role of US Treasuries in there as well. And of course, on further on the equities side, again, for very different reasons, Japanese equity, the lack of coherence in terms of the price behavior in Japan has been quite remarkable over the course of the past 12 months, and it's ebbed and flowed. And during those ebbs, we've tried to take opportunities to build that part of the portfolio. And we still think this has quite a long way to run in that respect.
Okay, Steve, well, that's been really interesting. Thank you very much for joining us.
Cheers, thank you very much.
And for more information on the M&G Episode Income Fund, please visit chelseafs.co.uk.